Good morning everyone. My name is Ram Dhamija. Welcome to my channel. Today is 14th of September, Sunday, and I'm here with a weekly video on how the market is looking going ahead into next week. There's lots to discuss, lots of news events, news flows, which will determine the market direction. One of the major ones being the Fed meeting, which will determine the rate cut. And otherwise, over last week, market has been stable. It has been good. It has been moving up with a upward bias. The lows that we had made on 29th of August have been respected, and from there we have just made one way up move for the first 10 days or trading days in September. So it's a good indication. Nifty has been consolidating and it is now firmly above 25,000, which is a good thing. So if there is no bad news which comes in, we can make a dash towards the all-time high, which is at 26,200. Also, the festive season is coming in. That typically brings in a good cheer and a good rally in the market. So let us see if this year also is going to be the same. So lots to discuss. Let's begin today's video. If you see, I'll start off with the Nifty chart over here first. This is the Nifty chart. As I was indicating that August 29th is when we made the bottom, the interim bottom at 24,400. This bottom we had made 2-3 times earlier as well. So we had made it on 8th of August. We had made it somewhere over here in June, July. This is 13th of June, and we have been in this range. So first time we had crossed this was on 12th of May, when that ceasefire news had come out of India, Pakistan. And from there, we made an interim top of 25,600, which has not been broken yet. We tried breaking it at 25,100. We did not succeed, but now we are making an attempt again. Now, if this 25,100 breaks, which I think it should anytime now, then we are headed towards 25,600 as a first stop. And then finally we are headed towards 26,200, which you can see in this blue line. This was the all-time high that was created in the markets long time back. So if you see, this was almost a year back, this was created, and we have not been able to come anywhere even close to it. And a lot of people were saying that this top we are not going to see in 2 years and this and that, and here we are almost there. So it's a good sign. It's a good sign that Nifty is actually headed upwards. Now this is another interesting chart. If you see, this basically shows the crossover between a 20 and a 50 DMA. Now whenever the crossover is on the negative side, that means 20 DMA crosses the 50 DMA on the downside, then usually it is slightly a bearish sign. But whenever 20 DMA actually moves above 50 DMA, it usually indicates a bullish sign. So if you see over here, the last crossover was somewhere in April, 4th of April it crossed, and from there we had a good rally going all the way 3,000-4,000 points. It briefly crossed down somewhere over here. This was in somewhere in July, and from there we have been just consolidating. So once this crossover happens, then it can be considered as a good bullish sign. Also, if you look at it, markets are usually typically weak below the 200 DMA. We are nowhere close to the 200 DMA. Thankfully, we reversed from here only, which was at 24,500. So we never touched 200 DMA. The last time we cracked below 200 DMA was somewhere over here. This is the crack. As you can see, this was in January of 2025 when we Nifty went below 200 DMA, and from there we know how it went down first in Feb, March, and then it went down on 7th of April, which was the final bottom made. So markets typically, when they're above 200 DMA, are strong, and and now with the crossover of 20 and 50 also happening, it looks like it's a double confirmation that the markets are strong. If you look at another parameter to see, this is the Nifty PE ratio. Now Nifty PE ratio is not very expensive. We are right now at a range of 21.9, which is considered median. The median is also somewhere over there, last 5 years median. So it's not very expensive, and if a rally actually happens, with the earnings also picking up, we should be placed all right. In terms of the near-term parameters also, like OI, etc., we are OI, I know, is very close indicator. It tells you what is going to happen over the week, so that is also placed at 1, so which is absolutely fine. This is okay, so I'll come to small caps and so on. First, let's look at the banking. This is the Banknifty chart. The Banknifty also crossed a good level of 54,380. This was a last resistance over here, and we cleanly went over it. Now the next stop for Bank Nifty is going to be about the all-time high. So Bank Nifty also looks all right from here. It had gone into a weakness over here, but it has actually come back. So that's one good news. So Bank Nifty is strong. Nifty is very, very strong. So looks like, the rally can sustain. So we will have to wait and see for the confirmation. Now let us look at the other constituents, which is the mid cap. Now mid cap, it also corrected when Nifty was correcting. So again, from July we had seen the correction set in, and now it is going up. So let us see if midcap also is able to clear its recent highs. And midcap performance earlier was good, so it had almost reached its all-time high, but it was not able to clear it, and now it is again. So it is also firmly above its 200 DMA. The 20 is trying to cross over the 50, so it should be fine. Now coming to the small caps, this is something that I wanted to talk about. Now small cap again small cap has been slightly weaker than the mid caps. It has not been able to cross its all-time high, and it's nowhere near that. Also, it's in fact quite below that. It's 8-9% down, but small cap is also making a smart comeback. The problem in small cap is this: if you look at the small cap PE, it is still at about 32. Median PE is 29. So small cap is by no ways cheap. So for example, if you look at March 23, the small cap PE had gone to 16, 17, and that is where the rally in small caps really started. But right now the small cap PE is at 32, so it is nowhere cheap. However, having said that, what happens for retailers is that you either you can buy the index with the ETF, or you can buy, if you, let's say you are interested in buying small caps, then you buy them through mutual funds. Now what happens is that you will look at the ETF and the index P is at 32 and conclude that it is expensive. However, what typically happens is that there are a lot of mutual funds which are still trading at a 20 PE in small cap, and those mutual funds have been outperforming the market for a very long time. So even when you're constructing your portfolio, you actually need to look which small caps mutual funds are doing well within the category. So a lot of times what can happen is that the market can be expensive, but you will still find good value picks in mutual funds that will ensure that your portfolio PE is not very, very expensive. So there are a lot of mutual funds in the small cap segment which are not very expensive, and the same goes for all the other market caps also. I'm not saying, advocating over here that one should look at only small cap, but I'm just using this as an example to show to you that even if the market is cheap or expensive, within that also there are funds which will be inexpensive, and they will tend to outperform. So as I've been maintaining, it is a good time to construct your portfolios. Whenever the markets have been correcting, it's a good time to construct your portfolios. Please look at buying at every opportunity, every dip, and I'm sure a lot of you have heeded to that advice and created your portfolios. I get a lot of calls from people in terms of please evaluate whether my portfolio is right or wrong. So I do that. I am a mutual fund distributor. I help people build their portfolios as well. So if anyone is interested in building their portfolio, they can contact me through the Google form in the description below. So coming back to that point, yes, that small cap as a segment is expensive, but within that small cap there are a lot of mutual funds which are not very expensive, and their portfolios have been built very beautifully. I was going through a couple of them, and I realized that the fund managers do put in a lot of effort. So as a retail investor, it is almost impossible to beat the fund managers. So because especially the good ones, the good fund houses have been, and you can see that in their track records, 15, 16, 18% kind of CAGR they have delivered over so many years. So they know what they're doing. And as a retailer, I think majority of funds portfolio should be in mutual fund, but at least my majority of my portfolio is in mutual funds. And that is what I've realized after so many years, that it's very, either you are a full-time investor, then it's okay, but if you have a day job, if you have some other business, then you should leave majority of your money in the hands of good, safe mutual funds with good fund managers to take care of it. So let us move ahead. This was that. Now let us look at where we are in terms of the indices from their all-time highs. Autos is leading the pack after the GST rate cut. So is PSU Bank. This is so you can see in this column F is where it shows how much the indexes are down from their peak. So PSU Bank is down minus 3.39%. Midcap is now almost reaching its all-time high. It's at minus 3.73%. Nifty 50 is at minus 4.43%. So a couple of good news, and we are there at the all-time high. So we are not very far away from that. Banknifty banking is -5. It was much ahead of Nifty, but now it has fallen behind. Small cap is -7.4, as I was saying. Nifty next is at -12.5. Commodities is -10. So commodities is also trying to make some sort of a comeback. FMCG is -14.87. Alpha is -19, so it has broken down, broken under -20. It was earlier -21, 22. Momentum is still very weak at -20, and IT continues to be a laggard at -21. So this is the situation in terms of the indexes. Now let us look at the global cues. There was a joint statement from Secretary Bessent and Ambassador Greer on emergency G7 finance call. So what they are saying is that G7 should also put in tariffs on countries which are purchasing oil from Russia. So we have some good news coming in of where leaders of both US and India have been saying that we need to work on the tariffs, and hopefully there have been good news coming in that tariff situation should get resolved by October, November. But on the other hand, these kind of news are also coming in, so we have to be careful. Thankfully India is not mentioned in this G7 thing, but we have to be careful how things play out, because if any tariff comes from EU or G7 and all, then it's going to be, markets are not ready for that. In terms of the other international cues, let us look at that. So US 30 years and 10 years are right now behaving well. So they're at 4.6 and 4, which is good, but they're slightly inched up. But I'll tell you, the alarm bell should ring if US 30-year crosses 5 and US 10-year crosses 4.5. Till the time these two levels are not crossed, it is all fine. US S&P VIX is down 14.76, which is great news. Nasdaq is crossed 24,000 now, which is amazing. It had gone to some 17,000-18,000 during April, so it's been one of the best rallies in Nasdaq that have happened in the recent past, and it's been almost 40% rally that has happened since April. So anyone who bought during April lows will be sitting pretty. And again, these are the times when you have to buy. I remember during the tariff day on April 7th, everyone was very scared. What shall we do? And this is the end of the world and all. All the markets were down. It was a panic bottom. That was the right time to buy. So anyone who bought in at that point in time will be up hugely, be it India, be it US, be it gold, be it anything. So those are the times when you really need a distributor or a advisor to guide you, handhold you, tell you that this is the right time. I also keep on advocating this on my group to my clients. Whenever there is a fall, I tell them, please buy. This is a good time to buy, and a lot of them do. And it really makes a difference of 1 to 2% in terms of their returns. If you buy during the down phases, then it actually turns out to be much better. It adds 1 to 2% to your CAGR depending on what fall you have bought into. So it's very important, to take the benefit of such situations. Now look at S&P 500 was flat. The futures are flat. US dollar index is at 97, which is great news. Brent oil is at 66, which is again very good. Brent, and anything below 80 is good for India, so it is at 66, which is excellent. Our currency continues to slide down. It is at 88.277. There is, and I suspect it is going to continue till the time we have a tariff deal in place. Gold is in another orbit. It is at 36.86. There is a very nice chart I will wanted to show you. Have a look at this. This is in slightly fun mode, but it shows that gold at 3,500 only 2 people are buying, gold at 5,000 3 people are buying, and when gold reaches 10,000, then there is going to be a rush. So I'm of that opinion, that gold is going to go up much higher from here. So if you look at this, is the gold chart, 36.86. It's not stopping. This is in dollars, and in India I think it's at 1,10,000 or something. So it has touched 3,700, and it is going one way. So you can see even in the last 1 month, gold has gone up by 8%, as you can see over here. And in 3 months, 6 months, it's gone 23%. 1 year, it's gone 42%. In INR terms, that's almost 50%, and so on. So gold has been on a relentless tear. And if you read a little bit more, and if you listen to YouTube, and a lot of people have said about this, the debt crisis in US has been unfolding, and they are reducing the interest rates when the inflation is actually at 3% plus. So Fed rate, policy rate is 2%, so they are supposed to reduce the rates when it's at 2%, but they're reducing it when the inflation is at 3%. So already everything is at an all-time high, and Fed is reducing the rate. So that is going to add to liquidity, and that is is going to add to the asset prices going up even further. So expect gold also to go up. That is my expectation, and I might be wrong in this, but I have been an accumulator of gold for a very long time. So and I have been advocating that it should be part of your portfolio as well. So gold has been going up. Silver, the poorer cousin of gold, has been doing even better. So if you look at, this is the silver chart in INR. Yesterday only it went up by 3%. Look at this candle. I mean, there's a silver ETF in India, silver beast. So look at this. It was at 92 about 2-3 months back. It is at 123. So it's just one way rally. Silver has been outperforming gold this year. So silver is something that is another thing that you need to be. So I keep on coming across a lot of things, but I just like to show you one. Ray Dalio urges investors to prioritize gold over treasuries for stability. And these are guys who are masters in their fields. So Dalio manages the biggest hedge fund in the world. He has been advocating about gold. So you can read about all these things, why he has been advocating, and how the debt crisis is going to unfold, and so on and so forth. So Dalio suggests that investor reassess the traditional portfolio mix of 60 stocks and 40 bonds. 60-40 used to work. It used to work brilliantly. If you see all the classical books by Graham and all, they advocate 60-40, and so on. But that stopped working in 2022. Something happened over there when this broke down. So bonds suddenly, they have been in the biggest bear market in US for the last 3-4 years. So, that is also because a lot of things in the monetary system are not all right. The money printing, the debt levels in US and so on are not in sync. So that ratio has kind of broken down. So I think gold is what comes in and steps in over there. So 10% allocation to gold really helps. And I'm not even talking about over here fiat currency getting devalued completely or so on and so forth. But that is a doomsday scenario. But even without that, you are seeing the price action yourself in front of your eyes, and if you don't own it, then who is to blame? So you should reassess. If you don't understand these things, please talk to a financial advisor, please talk to a mutual fund distributor, please talk to someone who knows more than you in the markets, and take advice. Then reassess yourself, and decision of course lies with you, but you should always take advice. That is my limited point. Now what else is there? Yeah, so this is the important one. Next Fed meeting, when is it? In September. What to expect? So Fed meeting is there in a couple of days, and traders are pricing a 93% chance that central bankers will cut the rate by 1/4 percentage points from 4 to 4.25. So I have already mentioned that if that happens, then you can expect a good movement in the markets. There is a slight talk of 0.5 also coming in, but 0.25 is kind of pretty much factored in. So that's it from me now. So our markets are good, outlook is good. We might have a dash towards our all-time high if things go okay. If there's no bad news coming in, then I expect markets to remain firm. That is the view as of now, unless the data changes and the market changes. But otherwise, I will be trading with a slightly longish long bias. Though my trades are mostly neutral, I'm a delta neutral trader, so it really doesn't matter to me if the market goes up or down. But it does matter to me in my investments a lot, because whenever the markets go up, your investments go up. So to that extent, it's all good. It's all good. Last week has been good, and let's hope that that continues. And you can also share your views in the comment section. How has your trading been? How's been your investing been? What is it that you see the market levels to be? I like to read your comments, and please do subscribe to the channel. And in case you're interested for mutual fund portfolio, then you can fill up the form. So that's it from me now. Have a nice weekend, and I shall see you soon. Take care. Bye bye.